If you are looking for income and some of the highest distribution yields around, there are two ETFs still in their infancy that are yielding around 58% and 67% currently. These ETFs are solely focused on income generation. Might they be something you should consider? To put that yield into real dollar terms, if someone was to buy $1,000 worth of shares in each of these ETFs today, they would generate 66 a month and 54 a month respectively if the yields were to remain similar moving forward. On a larger scale, a $100,000 investment in each at the beginning of the year would have generated a combined $23,500 or so in income year to date. But before buying into these or any high-yielding derivatives, the questions I would ask are you seeking current income? How important is capital preservation? Do you know how to buy downside protection yourself with puts on the underlying stock to offset one of the major downside risks? And what will you do with the dividends? The distributions seem to need to go into something that will do a better job of capital preservation if you are not planning to live off the income currently. Today's video is another subscriber request from a comment on one of my other ETF reviews. If you have any video requests, please ask and I will do my best to accommodate. I am currently working on an options basics video I hope to publish in the next few days. That will be the first video in a series on options. The fund review request was for ticker TSLY, the Yieldmax Tesla Option Income Strategy ETF. I had not heard of this one before or this ETF family Yieldmax in general. When I went to start looking into this fund, I noticed there is another ETF of the same fund family that started the same date, November 22nd of last year. It operates in the same manner. That fund ticker is OARK. It's the Yieldmax Innovation Option Income Strategy ETF. That is off of the ARK Innovation ETF ticker ARKK. So this review will be focused on TSLY, but it seems to apply to the others listed here as well. You can see there's Apple and Nvidia following the same strategy coming soon. Let's start with a chart comparison. Even though the ETFs are only a few months old, there has already been some dynamic price action to the up and downside. Comparing the two, you can see that TSLY falls slightly less in overall percentage on downtrends, mostly due to the options income, and it only has about half as much as upside as buying the straight Tesla stock. But that's to be expected since TSLY seeks income, Tesla is focused on growth and it doesn't pay a dividend. Looking at the ARKK to OARK chart, you can see the same pattern, not quite as much downside and a cap on the upside gain since it seeks to generate income. In the Statement of Additional Information publication, they also list a number of other securities it seems like they will be doing this strategy with in the future. I am going to assume that all of the ETFs in this fund family follow the same structure and approach, since OARK and TSLY already do. And then you can keep the others on your radar as well if these interest you. I would assume that they all have the same expense ratio of 0.99 like the existing two. You can see that Amazon, Berkshire Bee, Coinbase, Meta, Google, Netflix, and Square are forthcoming. Here you can see the monthly distributions of each of the funds over the last 3 months. They are new, so they just started paying out in January. It's a good time to talk about taxes while we're discussing these distributions, because most, if not all, of these dividends are taxed as ordinary income, since the income is generated from options premiums and a small amount from the cash and treasuries. You'll want to hold something like this in a tax-advantaged account if possible. Remember, in a taxable account, dividends are taxable whether you reinvest them or not. Further adding to their mystery, neither of them actually own the underlying stock or ETF reflected in their names. They are artificially created using option strategies instead of actually buying straight shares. How are they accomplishing those yields? Instead of buying shares, they create a synthetic long position with call and put options. They buy calls and sell puts simultaneously on the same contract strike price and expiration date. This combination replicates, or at least seeks to closely replicate, the price action of Tesla over that time period. They then sell out of the money covered calls to generate premiums, which they distribute as income on a monthly basis. Clearly, the amount they are generating as income as a result of this strategy is really high. They also hold U.S. Treasuries and cash as collateral against their synthetic long position. Tesla has high liquidity and frequent contract expiration, which means the fund managers have a lot of discretion. They can ladder the options contracts to help maximize the chances of getting the magnitude and direction of short-term moves correct. I'll show the actual holdings inside in a second, but here's the general idea. They buy call options long at the money, meaning around the same price it trades at right now. They also at the same time sell put options at the money, and that's how they create the synthetic long position. Then they sell call options out of the money, usually 5 to 15% above the current price, and then they hold treasuries and cash as collateral. And here's what that looks like in their actual holdings in practice. The negatives in the shares denotes the option contracts that they sell to open. I've monitored the holdings over the last week, and the number of contracts has steadily risen. I think that means that they have money being added to the fund and they are incorporating it into the portfolio daily. The number of contracts, 880, on both the buy and sell side, tell me they are seeking to limit risk. But if they get these number of contracts wrong ever, it could result in unprotected risk, which can get out of hand quickly with these derivatives. All of the Yieldmax strategies are off of high growth oriented companies that aren't typically known for paying high dividend yields. Since the companies have dynamic price action, they can generate high premiums since the implied volatility is higher than a less dynamic stock or ETF. Keep in mind, though, that in a rising interest rate environment where money becomes more expensive, growth companies can suffer as the cost of capital rises. The price of the underlying security of the derivative could continue to go down in an expensive money environment, which would also be a risk to these ETFs. Before the last 15 years of low to 0% interest rates, there were times where value stocks outperformed growth. So don't let recency bias of growth outperformance numb you to the fact that there may be a place for value-oriented assets in your portfolio as well. Maybe it would even make sense if you are still in the getting wealthy phase to take these distributions and buy value assets that have a capital preservation side. And why might it help to know how to buy downside protection? Well, the prospectus warns the fund will seek to employ its investment strategy regardless of whether there are periods of adverse market economic or other conditions, and will not seek to take temporary defensive positions during such periods, meaning they're not going to do it for you. For the ETFs that are based off of one company like TSLY, there's significant company risk on those. If something happened to Tesla or one of the other underlying, you see Coinbase recently in the news, for example, if that Coinbase one comes to fruition, that could have significant risk because it's tied to one company. OARK, that is the one that goes off of ARKK. ARKK typically has between 35 and 55 holdings, so you'd be diversified a bit more than one specific company. You can diversify away from company risk by making sure to have a solid asset allocation, and make sure if you buy things like these, it fits into your overall plan. I would first gut check into these two major risks. The first is long-term erosion of the NAV, the net asset value, due to high distributions. This is a risk similar to QYLD, which I examined in another video. It's just likely to have price erosion over time because it is putting out a big dividend every month, and the price decreases by the dividend every time it's distributed. Second risk is derivatives risk. The derivative strategies they use are highly leveraged. Always keep in mind, leverage giveth, leverage taketh away. The prospectus basically says we try to get it right on exposure, but we could get it wrong, and the fund could blow up if we are wrong enough. So when it comes to the big question, does this have a role in your portfolio? If you are comfortable with the risks and in the getting wealthy stage, you could potentially use the high dividends to partly reinvest and partly buy value-oriented assets. You might also consider buying puts on Tesla when it gets overextended to protect against downside moves and specific company risk. If you are in the already wealthy phase and are looking for high yield on a specific portion of your portfolio and you don't necessarily need capital appreciation on those specific dollars because you have other growth assets, then this could provide a different strategy to provide you with a higher income than you can find elsewhere. I think that about wraps us up for today. If you have any questions or comments, please leave them below and stay tuned for more content to come. Till next time.